Hello, with me today I have Chris St John, manager of the AXA Framlington UK Mid-Cap Fund. So Chris, has there been any activity in the your mid-cap fund recently? And if so, could you just explain the thinking behind your decisions?
Yeah, as I said earlier, the tenor of the fund is relatively low. So there's been no big structural changes to the fund. There's been plenty of ongoing development in terms of my sort of strategic thinking. The development of this comes from a whole host of places, one of which are the company management teams that I meet. I meet a lot of chief executives, a lot of finance directors who are running these businesses. That gives me the chance to talk to them about their companies, but also about competition, how they're dealing with the banks, any changes in their end markets which might be affecting them. And so certainly through this whole COVID period, what we've seen typically is an acceleration of what we were having before. So incremental speed and growth of internet retail, companies deploying technology even faster to give them a competitive advantage, and some other sort of interesting nuances around the edge as well. More and more of us are working from home, and I think what companies are realizing is that they don't need to just recruit employees in the local vicinity. So companies like Telecom Plus, for example, which is held in the fund, it's a utility provider, they no longer feel that they need to staff their call centers physically and using people in a particular location in North London. They are happy now to start recruiting from further afield, and as a consequence of this, you're seeing companies looking to recruit nationally. That can take shortage of labour issues out of the equation, and also helps companies to manage the cost base in terms of the amount they're paying for their employees. So for a variety of reasons, one of those being this dynamic, changing way of employing people led to me taking an investment in Telecom Plus in the mid-cap fund. I've been involved in a fundraising for Rank, which owns the Grosvenor casinos and has an online offering as well. This is a company that generated over £200 million of EBITDA before the crisis, but because Grosvenor casinos, their physical estate has been closed, that's led to a dramatic fall in the profitability of that business and a commensurate fall in the market capitalization as well. So that's a business that became particularly cheap as a consequence of closing. However, because its closing was running up significant losses and needed recapitalizing. Now, it now has a recapitalized balance sheet and still has the potential, I think, once the world returns to some sort of normality, and by that I mean people have a chance to congregate, meet, go out, go back to enjoying experiences, has a chance for its profitability to grow back towards where it was in 2019. I mentioned Pets at Home earlier. That was addition during the very tough periods in 2020. That's become a top 10 holding within the fund, and it's a holding I'm committed to as well. One other example, Chemring, a defence company. Very often in the UK, people get slightly down on the tech sector. We don't have the same tech companies that the US market has. However, I think that understates the technology companies that sit within other businesses, and within Chemring there's a fantastic business called Roke, which has a market-leading cyber security offering, but also companies are using technology to make themselves a lot more efficient and effective as well. And that, if those companies are supplying into supportive, growing end markets, can only be beneficial ultimately to the equity holders. So we remain very excited about these holdings, and we continue to look. We're seeing a big uptick at the moment in the IPO market, so I think that gives potential opportunity going forwards as well.
Well, you also own a lot of what stocks that fit into the financial sector. It's about 18% of your portfolio currently, I understand. What is it about the sector, and what do you think of the banks at the moment?
Yeah, the mid-cap financial sector is very different to the FTSE 100. So people will naturally think of banks when they think of the financial sector, and you'd be right to do so when you're thinking from an all-share perspective. Banks are not represented in any way to the same extent in the FTSE 250. There are banks in the mid-cap space, like Metro Bank, for example, would be one that people may recognise given its high street presence. Banks themselves are incredibly complicated businesses. They are very leveraged to the economy in particular. They're financially leveraged as well. And they found life very difficult with falling interest rates to make money or to make returns and grow their income on the capital that they lend. They are well capitalised, however. So those that hold banks don't completely despair. They're well capitalised. Over time, the dividends, at least to a small degree, will return. But this isn't a big part of the FTSE 250 area. That financial space is made up much more. It's a much more eclectic mix of businesses. There are private wealth managers in there, such as Rathbones, which is held. There are insurance companies, Lloyd's insurers are on there, companies like Lancashire and Hiscox. And there are also quite a big percentage of property companies, particularly REITs, real estate investment trusts, which typically pay pretty high dividends as part of being having a REIT structure. So it's very different to the FTSE 100. Our holdings are spread reasonably across the categories I've mentioned. We do have a holding in Rathbones, a private wealth bank. SafeStore, which is a self-storage company, so very, very different self-storage. And we do have one alternative bank, One Savings Bank, which is an expert in corporate buy-to-let lending. So it's a very, very different mix of businesses, different profit drivers in terms of a sector within the 250 index, and as a financial sector, very different to the FTSE 100, which is made up principally of banks.
Of course. Now, for private investors sort of navigating 2021, is there sort of one top tip that you would have for them in terms of that portfolio and outlook this year?
This is always a tricky one to answer, because whatever I say, someone's gonna have a chat to me in a pub if we're ever allowed to go back and say, why did you give me such a rubbish piece of advice? So I certainly won't make it stock specific. I think really patience is absolutely vital in equity investing. These are long duration assets. The capital flow, the amount of buyers and sellers will push shares around and make them very volatile in the short term. But if you're going to invest on the fundamentals of a company, it takes a long time for those fundamentals to be reflected into the underlying equity price. So I would say be very patient and invest to the limits of your own incompetence as well. If you don't understand what you're investing in, it's probably a good idea not to do so.
Sound advice. Chris St. John, manager of the AXA Framlington UK Mid Cap Fund. Thank you for joining me today.
Pleasure. Thanks very much.